Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
Welcome back to Safe Simple Sound. This episode number 30. This is also our second episode in the series about investing in stock market. Let's start with a specific scenario. A hot new tech company is about to go public on the Nasdaq. Should you jump in and buy shares on the first day, or is it wiser to wait? Sam, Taylor, what are your initial thoughts?
This reminds me of what I read online about market orders and limit orders. I'm wondering if a limit order would be safer in this situation. With all the hype around a tech IPO, it feels like the price could swing wildly.
That's a great point, Taylor. A limit order could help you avoid buying at an inflated price. IPOs can be very volatile, especially on that first day. Think of it like the opening of a new trendy restaurant. Everyone rushes in at once, creating a long line and potentially a wait. Some might be willing to pay a premium just to get in early, but is the food actually worth the inflated price on opening day? You might get a better experience and a better deal if you wait a few weeks for the initial rush to subside.
So, Sam, what are the potential advantages and disadvantages of buying an IPO on its first day of trading?
The main advantage is the potential for significant gains. If the company performs well, the price could soar on its debut. However, the biggest disadvantage is the inherent risk. The price can be driven by hype more than fundamentals. You're essentially betting on the future, often with limited historical data. The Nasdaq's fully electronic trading system, while efficient, can amplify volatility. Algorithms and high-frequency trading can create rapid price swings.
How might the Nasdaq's electronic trading system impact the stock's price volatility?
Imagine thousands of computers making buy and sell decisions in fractions of a second. This can create significant price swings, particularly with a high-profile IPO where demand is uncertain. A small change in sentiment can be magnified by these electronic systems.
So if I understand correctly, the electronic trading system of the Nasdaq, while making trading very efficient, can actually increase the risk of an IPO investment due to increased volatility.
Precisely, Taylor. It's a double-edged sword, efficiency and speed, but also amplified risk.
Now, where could an investor go to learn more about the company's financials and potential for growth so they can make an informed decision?
The company's prospectus, filed with the SEC, is essential reading. This document provides detailed information about the company's business model, financials, and risk factors. Independent research from reputable financial analysts is also valuable.
It sounds like researching the prospectus, which is regulated by the SEC, is a crucial step.
Exactly, Taylor. The SEC plays a critical role in ensuring transparency. So let's recap. Buying an IPO on the first day has the potential for high reward, but also high risk. The Nasdaq's electronic system, while efficient, can amplify volatility, and researching the company's financials through the prospectus and independent analysis is crucial.
One final thought. Remember, every IPO is different. A hot debut doesn't guarantee long-term success. Look beyond the hype and consider the company's fundamentals.
Great advice, Sam. Thanks for sharing your insights. To our listeners, IPOs can be an exciting part of the market, but research carefully before investing and consider your risk tolerance. Next, we're diving into a scenario we're calling the blue chip buy. Imagine, Taylor, you're considering adding a well-established large company to your portfolio, a classic blue chip stock, and it's listed on the New York Stock Exchange. How do the NYSE's listing requirements and trading floor dynamics influence your decision?
Okay, blue chip. I remember us talking about that briefly before. It's like the big, reliable companies, right? Like the Coca-Colas and Microsofts of the world.
Exactly. Generally, blue chip companies are those with a long history of stable earnings, large market capitalization, and consistent dividend payments. They're often considered less volatile than newer or smaller companies.
So, Taylor, with that in mind, what factors might make a company listed on the NYSE a more stable investment than a newer company on the NASDAQ, for example?
Well, I read recently about stricter listing requirements for the NYSE, so I'm guessing that filters out some of the riskier companies?
Precisely. The NYSE has rigorous requirements regarding market capitalization, revenue, and corporate governance. Think of it as a premium club. A company needs to prove its financial stability and operational maturity to even be considered. This generally translates to lower risk for investors, although no investment is entirely risk-free.
That's a great point, Sam. And how does this focus on larger, well-established companies affect the NYSE's trading environment, Sam?
It tends to create a more liquid market. With larger companies, there are typically more shares available and a higher volume of trading. This means it's generally easier to buy and sell shares quickly without significantly impacting the price. Liquidity plays a key role in how those orders execute.
A more liquid market usually means a tighter spread, right? Making it cheaper to buy and sell.
Absolutely.
So, let's say you've identified a blue chip company on the NYSE that you're interested in. What resources could you use, Taylor, to evaluate its long-term performance?
Should I be using a broker? Most online brokerage platforms offer research tools, charting tools, company financials, that kind of thing, right?
Yes, those are excellent resources. You can also look into independent financial research firms, annual reports filed with the SEC, and even reputable financial news outlets. Comparing the company's performance against its industry peers is also crucial for a comprehensive evaluation.
So, to recap, blue chip companies listed on the NYSE often offer greater stability due to stringent listing requirements and a liquid trading environment. However, remember that thorough research is still essential before investing.
So, if I understand correctly, while the NYSE's structure provides a certain level of assurance, I still need to do my due diligence.
Exactly, no investment is entirely risk-free. We've covered a lot of ground today. Remember, diversification is key to a healthy portfolio. Consider a mix of established companies and newer high-growth potential companies. Stay informed about market trends and never invest more than you can afford to lose. Now, we're going to dive into a specific scenario we've titled the market order mishap. Imagine an investor wanting to buy a stock that's been all over the news, let's say a popular electric vehicle company. They decide to place a market order during a particularly busy trading day, assuming they'll get a price close to what they see on their screen. However, when the order executes, the price they end up paying is significantly higher than expected. Ouch. So, the question is, what went wrong? Sam, why can market orders be risky, especially during periods of high volatility?
Market orders prioritize speed of execution over price certainty. The order essentially says, buy this stock at whatever the best available price is right now. During periods of high volatility, prices can fluctuate rapidly. So between the time you see a price on your screen and the time your order actually executes, the best available price can change dramatically. Think of it like trying to catch a moving train. If the train is moving slowly, it's easy to hop on. But if it's speeding up and slowing down erratically, you might end up missing it or grabbing onto the wrong car at the wrong price.
So, if I understand correctly, the investor in our scenario was essentially saying buy at any price, and during the volatile period, the price jumped up before their order could go through. That doesn't sound very safe. But what about market makers? Aren't they supposed to provide liquidity? Seems like they can't keep up with rapid price swings, right?
Exactly. Market makers help smooth out price fluctuations, but during extreme volatility, even they might struggle to keep up. Imagine a sudden surge of buy orders. The market maker's available shares at the lower price quickly get snapped up, and the next available shares are offered at a higher price. If our investor's market order lands during that surge, they'll buy at the higher price.
That's a great analogy, Sam. Taylor, what alternatives to market orders could our investor have considered to avoid this situation?
Well, how about limit orders? Could they have set a limit order to buy at or below a specific price? That way, they wouldn't get stuck paying more than they were willing to.
Absolutely. A limit order sets a ceiling on the buy price. It tells the exchange only buy if the price is at or below this level. It gives you price control but doesn't guarantee execution. If the price never drops to your limit, the order won't fill.
Right? There's a trade off between speed and control. And Sam, how can investors protect themselves from these unexpected price fluctuations when executing trades beyond using limit orders?
Several ways. First, understanding the market conditions is crucial. Avoid placing market orders during periods of high volatility if you're concerned about price fluctuations. Second, consider using stop limit orders, which combine the features of a stop order and a limit order. A stop limit order turns into a limit order once the stop price is reached, preventing you from buying at a much higher price in case of a rapid price surge. Finally, consult with a financial advisor. They can help you develop a trading strategy that aligns with your risk tolerance and investment goals.
Let's recap. Market orders are great for highly liquid stocks under normal market conditions, but during volatile periods, they expose you to the risk of unexpected price swings. Limit orders give you more control over price but might not execute, and stop limit orders offer a combined approach for even more protection. Taylor, do you have any final thoughts on this scenario?
I think the main takeaway for me is that different order types exist for a reason. It's important to understand the risks and benefits of each one, especially in a volatile market. You can avoid unpleasant surprises like our market order mishap by being a bit more strategic.
Excellent point, Taylor. And for our listeners, the key takeaway is this. Before placing any trade, take a moment to understand the risks and benefits of different order types. Don't let a market order mishap derail your investment journey. Let's continue our discussion about order types and trading strategies. Our next scenario, the limit order letdown, features an investor, let's call her Sarah, who set a limit order to buy a stock at a specific price, but the order never executes. The stock price hovers just above her limit price for days, leaving Sarah frustrated. So let's dive in and understand what happened. Sam, as our expert, what are the limitations of limit orders and when might they be ineffective?
Limit orders are great for price protection, but they don't guarantee execution. They only execute if the market price reaches or goes below your buy limit or at or above your sell limit. If the price never reaches your limit, the order sits unfilled. This can happen in illiquid markets where there are fewer buyers and sellers, or if the stock price is highly volatile and jumps past your limit.
So if I understand correctly, a limit order is like saying, I'll buy this stock only if I can get it for this price or less. But if the price never drops to that level, the order just sits there.
Exactly. Think of it like putting in a bid at an auction. If your bid is too low, you won't win the item.
Great analogy, Sam. Now, how can investors adjust their limit orders to increase the likelihood of execution while still maintaining some price discipline?
Several options exist. First, they could increase their buy limit price slightly. This increases the chance of execution, though they might pay a bit more. Second, they could use a good till canceled order, which remains active until filled or canceled. This removes the risk of the order expiring before execution. Finally, and this is a bit more advanced, they could explore using stop limit orders, which become limit orders once the stop price is triggered. This can be useful in dynamic markets.
This reminds me of what we discussed about market orders last time. With a market order, you're guaranteed execution, but you could end up paying more than you intended if the price moves quickly. So it's a trade-off between price certainty and execution guarantee, right?
Precisely, Taylor. Sam, what factors should investors consider when setting limit prices?
The key factors are the current market price, the stock's volatility, and their own risk tolerance. If the stock is volatile, setting the limit too far from the market price might reduce the chance of execution. Conversely, setting it too close might mean getting filled at a price not much better than a market order would have gotten. It's a balancing act. Investors also need to consider their overall investment strategy. Are they long-term investors who are less sensitive to short-term price fluctuations, or are they short-term traders who need tighter price control?
So, if I'm a long-term investor, I might be willing to wait a bit longer and set my limit price a little lower. But if I'm trying to make a quick trade, I might set my limit closer to the current price, even if it means paying slightly more.
Exactly. Let's recap. Limit orders are powerful tools for controlling price, but they don't guarantee execution. To increase the chance of execution, you can adjust your limit price, use GTC orders, or explore more advanced order types like stop limit orders. When setting limit prices, consider market conditions, volatility, and your individual investment goals.
One more point to consider, Taylor. Remember what we discussed about different exchanges? Some stocks are traded on multiple exchanges. Even if your limit price isn't met on one exchange, it might be hit on another. Your broker should automatically route your order to the exchange offering the best price, but it's good to be aware of this.
So even if my order isn't executing, it doesn't necessarily mean my limit price is completely unrealistic. It just might not have reached that price on the specific exchange where my order is currently routed.
Exactly right. And that highlights the importance of monitoring your limit orders and adjusting them as needed to reflect changing market conditions. Don't just set it and forget it. Be proactive. Let's discuss one more scenario on the topic of order types and trading strategies. This scenario focuses on the stop order, a tool designed to limit potential losses. Imagine Swift owns stock in a company called TechWave, and it's been declining recently. She decides to use a stop order to protect herself from further losses. So let's explore how this works. Sam, in what situations might a stop order be a useful tool for managing risk?
Stop orders are valuable when you want to limit downside risk but can't constantly monitor the market. Think of it as a safety net. For example, if Swift sets a stop order on TechWave at $90 and the price drops to that level, the order automatically triggers a market order to sell. This helps protect her from larger potential losses if the stock continues to decline. They're also useful for locking in profits. Say TechWave went up to $120 and Swift wants to ensure she retains at least $100 per share. A stop-loss order at $100 helps her achieve that.
So, if I understand correctly, a stop order is like an automatic sell order that activates when the stock hits a certain price. This reminds me of what we discussed about limit orders last time, where you set a specific price you're willing to buy or sell at. But with a stop order, it converts to a market order when the stop price is reached, right?
Precisely, Taylor. It's like setting a tripwire. Once the price hits that tripwire, the order springs into action. Now, Sam, what are the potential disadvantages of using stop orders?
A key disadvantage is the risk of getting stopped out prematurely during normal market fluctuations. Imagine TechWave briefly dips to $90 due to a temporary market downturn, triggering Swift stop order. But then, the price quickly rebounds to $100. She sold her shares unnecessarily. This is known as a false signal. Another issue is gap risk. If there's a significant negative news event overnight, TechWave could open much lower than Taylor's stop price, perhaps at $80. The stop order would execute closer to $80, not the $90 she intended.
Okay, that makes sense. Gap risk sounds like something that could be especially problematic during volatile market periods. So if I wanted to use a stop order, how can I determine an appropriate stop price that balances protection with the risk of being stopped out too early?
There are different approaches. One is percentage-based. For example, setting the stop price 5% or 10% below the current market price. Another approach is using technical analysis, identifying key support levels on the stock's chart. These are price points where the stock has historically found buying interest. Placing the stop order just below a support level might offer a better chance of avoiding a premature exit.
Right? It's a balancing act. As with any strategy, there's no perfect formula. Let's recap. Stop orders act as a safety net, helping limit losses or lock in profits. However, they carry the risk of being stopped out early due to market volatility or gaps. Setting the right stop price requires careful consideration of the stock's historical performance, market conditions, and your personal risk tolerance. This also connects back to our discussion on market mechanics. Remember how we discussed different exchanges and order matching? Your stop order will interact with those systems, potentially influencing the final execution price.
So if I were to use a stop order, I need to choose my stop price strategically, factoring in things like support levels and volatility, as Sam explained. And I also need to be aware that even with a stop order, I might not get the exact price I intended due to things like gap risk.
Exactly, Taylor. You've grasped the key points. Sam, anything else to add before we wrap up?
Just to reinforce, understanding your investment goals and risk tolerance is crucial. Stop orders are a tool, and like any tool, their effectiveness depends on how they are used. They aren't suitable for every situation.
Great advice, Sam. So, listeners, take some time to develop a risk management strategy that includes the appropriate use or even non use of stop orders. Think about your investment goals, your comfort level with risk, and how different order types might fit into your overall plan. We've been discussing the ins and outs of the US stock market, and now we're diving into a specific scenario. Imagine a company releases surprisingly good news after the market closes. You're tempted to buy shares right away in after hours trading, hoping to capitalize on the potential price jump. Is this a smart move? What are the risks and potential rewards? Let's explore this with Sam, our market expert, and Taylor, our inquisitive learner. Sam, Taylor, why might after hours trading be riskier than trading during regular market hours?
The key difference is liquidity, Alex. During regular hours from 9:30 a.m. to 4 p.m. Eastern Time, a huge number of buyers and sellers are active. That high volume creates what we call a liquid market. It's easy to buy and sell quickly at a fair price. After-hours trading has significantly fewer participants. This lower liquidity can lead to wider spreads between the bid and ask prices, meaning you might end up paying more to buy or receiving less when you sell.
So, if I understand correctly, it's like going to a bustling farmer's market during the day versus a small roadside stand late at night. During the day, you have lots of choices and competitive prices, but at night, you might have limited options and potentially higher prices because there's less competition.
That's a great analogy, Taylor. Now, how can investors access after hours trading, and what are the associated costs?
Most online brokerage platforms offer access to extended hours trading, including after hours. However, there might be specific eligibility requirements or additional fees. It's crucial to check with your broker about their specific policies and costs before diving in. Some brokers might restrict certain types of orders during extended hours too. For example, they may not allow limit orders.
This reminds me of what we discussed about different order types. During regular hours, we have options like market orders, limit orders, and stop orders. But in after-hours trading, our choices might be more limited, right?
Exactly. And even if you can place a limit order, the lower liquidity means there's a greater chance it won't execute.
Excellent point. What factors should investors consider before placing trades outside of regular market hours?
First, understand the news. Is it truly significant or is it being overblown? Second, assess your risk tolerance. Are you comfortable with the potential for price volatility and wider spreads? Third, remember that professional traders and institutions might also be active in after-hours trading, potentially putting individual investors at a disadvantage.
So, if a company announces a minor product update after hours, it might not be wise to jump in immediately because the news might not justify the added risk of after-hours trading. But if it's something major, like a significant acquisition or a groundbreaking new product, then it might be worth considering, but still with caution.
Precisely. It's all about weighing the potential benefits against the increased risks. Sam, any additional thoughts?
One more thing. Just because a stock moves up or down sharply after hours doesn't mean it will open at that price the next day. Things can change overnight.
Great point. Let's recap our key takeaways. After hours trading offers the potential to react quickly to news, but it comes with significantly increased risk due to lower liquidity and wider spreads. Accessing after hours trading usually requires specific permissions from your broker and may involve additional fees. Before trading outside regular market hours, carefully consider the news, your risk tolerance, and the potential for increased volatility. So, listeners, as always, do your homework, weigh the potential benefits of after-hours trading against the increased risks, and make informed decisions. We've been talking about the intricacies of the stock market, and in this segment, we're diving into the impact of institutional investors. Imagine a scenario where a large institution, like a pension fund, starts buying a lot of shares in a smaller company. Taylor, how do you think this might impact the stock price, and how should a retail investor like yourself react?
Well, if a big player is buying a lot of stock, it seems like demand would go up, which would push the price up, right? It's kind of like supply and demand for anything else. But I'm not sure what that means for me as a small-time investor. Should I jump on the bandwagon and buy too, or is that risky? This reminds me of when we discussed market orders versus limit orders. Would a limit order be helpful in this scenario?
You're right, Taylor. Increased demand from institutional buying typically drives up the price. Think of it like this. If suddenly everyone wanted a certain limited edition sneaker, the price would skyrocket. The same principle applies to stocks. As for whether you should follow suit, it's not that simple. Institutional investors have different goals, resources, and time horizons than retail investors. They might be seeing long-term potential that isn't immediately obvious, or they might be using strategies that don't apply to individual investors.
Excellent point, Sam. Let's unpack those differences a bit. So, Sam, how do institutional investors influence overall market trends and the price of individual stocks beyond just the simple supply and demand dynamic Taylor mentioned?
Their large trades can significantly move the market. A substantial buy order can create upward momentum, while a sell-off can trigger a decline, sometimes rapidly. They also influence sentiment. If a respected institution invests heavily in a particular sector, it can attract other investors, further boosting prices. Think about it like a celebrity endorsement.
So it's kind of like a self-fulfilling prophecy. If a big institution buys, others follow, driving the price up even more, regardless of the company's actual performance. That sounds a little risky. Are there any downsides to following institutional investors?
Absolutely. Chasing institutional money can be a dangerous game. Institutions often have access to information retail investors don't, and their strategies are often complex and not easily replicated. Plus, what works for a massive fund won't necessarily work for someone with a smaller portfolio. Copying their moves without understanding the rationale can lead to losses.
That's a crucial point. It's important to do your own research and not blindly follow institutional activity. This ties into my next question about staying informed about institutional trading. How can retail investors keep track of what these big players are doing, Sam?
SEC filings like 13Fs can offer some insights into institutional holdings, but they're backward-looking. Financial news outlets often report on large trades, which can give you a sense of where institutional money is flowing. But remember, this information is often delayed and doesn't reveal the full strategy behind the trades.
So if I understand correctly, while keeping an eye on institutional activity can be informative, it shouldn't be the sole basis for my investment decisions. It's more about adding another layer to my research, rather than just mimicking what they do. Right?
Precisely. It's about understanding the broader market context. To recap, large institutional investors can significantly move markets and individual stock prices, influencing trends and sentiment. While their actions can provide valuable insights, it's risky to blindly follow their lead. Retail investors should focus on their own individual goals and conduct thorough research before making investment decisions.
This has been really helpful in understanding how the market works beyond just buying and selling stocks.
Exactly. And remember, always do your own due diligence. Don't rely solely on what others are doing, especially the big institutional investors. Make informed decisions that align with your own financial goals and risk tolerance. Now we're diving into a thorny topic that often makes headlines: high-frequency trading, or HFT. Recent news has raised some eyebrows about its impact on market fairness. So Sam, let's unpack this. What are the potential benefits and drawbacks of high-frequency trading?
High-frequency trading, in its simplest form, is using powerful computers to execute a large number of trades incredibly quickly, often exploiting tiny price differences across different exchanges. Think of it like a super-fast automated version of arbitrage. A key benefit is increased liquidity. HFT firms provide a constant stream of buy and sell orders, which can make it easier for regular investors like you and me to execute our trades quickly and at a fair price, especially during volatile periods. However, there's a flip side. One concern is that it can create an uneven playing field. HFT firms, with their advanced technology, might be able to front-run larger orders, essentially predicting market movements and profiting at the expense of others.
So, if I understand correctly, it's like they're getting a sneak peek at what's about to happen in the market, giving them an unfair advantage. This reminds me of what we discussed about market makers, but on steroids.
That's a good analogy, Taylor. It's more complex than that, but you're on the right track. It's not necessarily a sneak peek, but rather the ability to react to information and execute trades milliseconds faster than anyone else. The difference between milliseconds can translate into significant profits in high-volume trading.
Exactly. And this brings us to another important question. How do regulators ensure fair markets in the presence of high-frequency trading? Sam?
Regulators like the SEC are constantly trying to keep up with HFT. They've implemented regulations aimed at preventing market manipulation and ensuring fair access. For example, market surveillance systems are used to detect unusual trading patterns that might suggest illegal activity, like spoofing, where traders place large orders they don't intend to fill to manipulate prices.
Spoofing sounds incredibly deceptive. So if regulators catch these HFT firms manipulating the market, what happens?
Penalties can include fines, trading suspensions, and even criminal charges in severe cases. The challenge for regulators is the sheer speed and complexity of HFT. It's like trying to referee a game played at warp speed.
And that leaves many investors wondering what they can do to protect themselves. What advice do you have for them, Sam?
One practical step is to use limit orders rather than market orders whenever possible. This helps protect you from sudden price swings that HFT algorithms might exploit. Also, be wary of trading during volatile market periods when HFT activity is often highest. Remember that the additional context we provided described different order types, including limit orders, which can be a useful tool here.
So if I'm placing a limit order to buy a stock at $50, even if there's a sudden price spike due to HFT activity, I won't end up buying it for, say, $55.
Exactly. Your order will only be executed if the price falls to $50 or below.
Excellent point, Taylor. Let's quickly recap. High-frequency trading offers potential benefits like increased liquidity, but also raises concerns about market fairness. Regulators work to mitigate these risks, but it's a constant challenge. Investors can take steps like using limit orders and being mindful of market volatility to protect themselves.
This whole discussion has been incredibly eye-opening. It really shows how technology is changing the market landscape, both for better and for worse.
It absolutely does, and that's why it's so important to stay informed. We encourage all our listeners to stay up to date on the ongoing debate surrounding high-frequency trading and its impact on the market. It's your money, your future, and knowledge is power. Now we're going to delve into a critical safety mechanism, the circuit breaker. Imagine a sudden, sharp market downturn, a cascade of selling that threatens to spiral out of control. This is where circuit breakers come in, acting like a temporary pause button on trading. We'll call this scenario the circuit breaker crisis. So Sam, let's unpack this. First, what events can trigger a circuit breaker, and how do they affect trading activity?
Circuit breakers are triggered by significant drops in a major market index, like the S&P 500. These drops are measured as percentages from the previous day's closing price. Different levels of decline trigger different lengths of trading halts. A smaller drop might pause trading for 15 minutes, while a more drastic decline could halt it for the rest of the day. This effectively stops the free fall by giving everyone a moment to breathe and reassess.
So if the market drops, say 7% really fast, everything just freezes. No more buying or selling.
Exactly. Think of it like a fire alarm going off. Everyone stops what they're doing, takes a moment to assess the situation, and then decides on the next course of action. This cool-down period can prevent panic selling from exacerbating the downturn.
That's a helpful analogy. Now, why do we have these in place? Sam, how do circuit breakers help protect investors and maintain market stability?
They serve multiple purposes. Primarily, they curb panic. When markets plummet, fear can drive irrational decisions. Circuit breakers provide a forced timeout, allowing investors to gather information and make calmer choices. This, in turn, can prevent a full-blown market crash. Secondly, they promote price discovery. A sudden, sharp drop doesn't always reflect the true value of assets. The pause allows for information to disseminate, helping prices stabilize around a more accurate reflection of market sentiment.
If trading halts, does that mean market makers can't step in and help stabilize prices?
Good point, Taylor. Market makers still have a role even when a circuit breaker is triggered. They can continue to quote bids and offers, which helps provide a sense of where the market might reopen. This isn't active trading, but it maintains a level of price transparency during the halt.
So, it's a pause, not a complete shutdown. Let's consider the other side. Sam, what are some criticisms of circuit breakers and how might they be improved?
Some argue they can create more volatility when the market reopens, as pent-up orders flood in. Others suggest they interfere with price discovery by artificially interrupting the natural flow of the market. One potential improvement is dynamic circuit breaker thresholds that adjust based on market volatility. Instead of fixed percentages, the trigger points could be influenced by factors like trading volume and price swings, offering a more responsive system.
So, if I understand correctly, circuit breakers aim to protect investors from panic selling and allow for more rational decision making during periods of high volatility. However, they might also create some unintended consequences, like increased volatility upon reopening.
That's a great summary, Taylor. To recap, circuit breakers are designed to halt trading during significant market downturns, preventing panic and promoting more rational decision making. They are triggered by percentage drops in major market indices, with different levels of decline leading to different halt durations. While they offer important protections, potential criticisms include creating pent-up volatility and potentially interfering with natural price discovery. Ongoing discussions about dynamic thresholds aim to refine their effectiveness. Understanding the role of circuit breakers is crucial for navigating market turbulence. Take some time to reflect on how these mechanisms impact both the market as a whole and individual investors, particularly during times of crisis. Join us next time as we continue exploring the fascinating world of stock markets.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at safesimplesound.com. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Until next time, take care and bye for now.